In the next section, we are going to talk about the people who participate in the financial markets. And we think of them as being risk averse. So they don't like to take high risk. They're essentially looking to build wealth for the future, and they're also looking to potentially hedge their risks. The other class of investor in the market we usually refer to as hedge funds or institutions. So we think of this as essentially being risk neutral. They are sophisticated and potentially informed. We don't mean that they are trading on private information because this is illegal, but what I mean is that they are sophisticated in understanding the prices, the price formation, perhaps liquidity or liquidity formation, and they're better able to predict short-term movements in prices. We think that those type of traders are primarily making profits. Hedge funds, sometimes they're also hedging their positions. What do we know about retail investors? Once again, I want to emphasize that we think that they don't trade on superior information. Essentially, they're just trading for private reasons. Many academic studies have shown that retail investors frequently hold inefficient portfolios. They could do better in their investment decisions. Another problem that they run into is that their portfolios are not properly diversified. Essentially, they are taking on too much risk for the return that they're getting. They also buy the wrong sorts of assets. Sometimes you can improve your overall wealth by buying assets that are not correlated. The other thing about the retail investors that's important to remember is that they typically face very high trading fees or trade way too much. So what about hedge funds? Hedge fund is a technical term, and it refers to a specific legal investment vehicle. It's limited in the number of people who participate, and there are certain disclosure requirements that come with the hedge funds. As a broad class, hedge funds are to some extent a black box. We don't quite know what goes inside them. We don't really understand the strategy that goes into this box. But what we know is that they take money from investors, typically high net worth individuals or sophisticated investors, and they generate return distributions. Please bear this in mind when we think about some of the portfolio management applications in DeFi that we are going to cover in the next lessons. I'm going to come back to this slide. Leverage. So one other characteristic of hedge funds that's useful to note is that they frequently take leverage positions. By leverage, I mean they borrow in order to invest, and leveraging is a very, very common practice in financial markets. You lever up a portfolio because you want to both increase the risk and the return. So to get a sense of how powerful leverage is, think about the following. You have $1 of your own money that you plan to invest. In addition, you borrow 50 cents. So you invest a total of $1.50 in the stock. For simplicity, let's just suppose that that stock has an equal probability of either doubling in value or halves. So what does the return distribution look like? In a positive side, right? So if the stock doubles, your investment of $1.5 turns into $3. And on the negative side, you are left with 75 cents. Both cases, you have to return the payment on the loan, which is the 50 cents, the amount that you borrow. Again, for simplicity, we are assuming that there is zero interest rate. So that leaves you in the positive case with $3 minus 50 cents, so $2.5. And on the negative side, it leaves you with 25 cents. If we are looking at the returns, on the positive side, you make 150% return, and on the negative side, you lose 75%. The leverage magnifies both returns and risk, because without a leverage, you have made 100% instead of 150, and you have lost 50% instead of 75%. Portfolio leverage is very attractive to institutional investors just because of the way it magnifies risk and returns. So sophisticated investors will also use various derivative securities in order to get leverage-like features. Let me give you an example of what happens when a sophisticated player is levered. You may remember the case of Archegos Capital, a very large bankruptcy that happened a few years ago. It was a hedge fund that borrowed from multiple prime brokers. You can think of a prime broker as essentially being a bank for hedge funds and institutional clients. So what was particular about this case is that none of the prime brokers had discussed with each other how much they actually lent to Archegos Capital. The other thing that you need to know to understand the sequence of the events is that the hedge fund had invested in a very concentrated portfolio. That means they only bought a limited number of assets. And in addition, they used those specific assets as collateral for the loans that they taken out from the different prime brokers. What happens is that there are some news events, and one of those securities dropped in price significantly. It got to a point that all the prime brokers were worried that the value of the collateral had fallen, and they issue margin calls and basically asked the hedge fund to come up with more capital or more proof that they could eventually repay the loan. Of course, Archegos couldn't do this. So what happened was one of the prime brokers started to sell the collateral, and the underlying securities dropped even further. Everyone else's collateral fell in value, and it became clearer and clearer that the hedge fund will not be able to repay its loan. The story of the Archegos Capital is a systematic event, with many different prime brokers being exposed to the same risk. Systematic risk is very high in the DeFi. So please, again, keep in mind this type of example when we go through the lending protocols, and I will explain a little bit in more details the systematic risk that happens with those platforms.